UnitedHealth's Optum is buying AbleTo for 10 times revenue. Is that a fair price? And what does it mean for you? We'll discuss that and more in the inaugural Mental Health Market Update today.
Welcome to the Mental Health Market Update, where we talk about what's happening in the mental health industry. Here's your host, Stephen Hayes.
Welcome to our first weekly Mental Health Market Update. Happy May 1st. It's the first day of Mental Health Month, and we're celebrating by launching a new weekly segment here on the Stigma podcast, where we're going to talk about the news that impacts the mental health market from an investor's point of view. I'm your host, Stephen Hayes, and I run a venture capital fund called What If Ventures that is solely focused on investing in startups within the mental health and addiction space. As such, I spend a lot of time researching what's going to impact startups, portfolio companies, investors, other constituents in our space, and I think about it from a positive and negative perspective. My weekly analysis includes anything from public market data to gathering private market insights and synthesizing news, research, etc. that I read each week. And what you can expect to hear on this show is analysis of a number of things with respect to how they impact the business of mental health. And those things include what happened in our market last week, what's impacting startups in our space, fundraising news, latest happenings with startups, investors, etc., public company valuations and update and news, what's going on with the payers, the providers, public companies that we comp to when we look at valuation in the early stage space, what's the government doing, what policies are changing, research that we've read, and finally, we'll be adding some of our insights based on what we've learned in the last week, based on our focus on the business of mental health and well-being. But that's enough explanation, so let's get into it. The big news this week is the acquisition in our space. UnitedHealth's Optum reported to be nearing a deal to buy virtual therapy provider AbleTo for about $470 million. This was reported on CNBC Monday, April 27th. And according to that report, the price represents a 10x multiple to AbleTo's forward revenue. Is that reasonable? Is that fair? What does that mean to others who may be raising money or selling a company in this space? Now, I've seen a lot of reactions this week. Some people are outraged at how high the price is. Some people think that it's an underbid, a lowball bid. Upon further evaluation, I think the price is somewhat low to fair. But let's dig in. When we talk about valuation, we like to start with comps. So I'm an investment banker by trade, so I want to look at the public trading comps. And if you're a startup founder, the valuation or in valuation, corporate finance is a mystery to you, then listen up, because this is a primer in Valuation 101. What is a comp, you might ask? It's a comparable. We take known information about a public company that has similar characteristics and use that to triangulate assumptions about the value of another business that might be similar in some way. Doesn't mean that it has to be a competitor or that it has to do the same thing or you sell the same products. A good comp is a subjective term, and sometimes we can't find good comps. And so we'll look for businesses with similar growth or margin profiles or that have other common characteristics when we're trying to figure out the valuation of our business or the target we're looking at. For AbleTo, I initially looked at One Medical. One Medical is the most recent healthcare IPO. It's a high growth name, venture backed. And then after that, I started looking at Teledyne. They've been in the remote healthcare business for a very long time. I included other what I call disruptive healthcare providers in my comp set as well, which it's not a term I came up with. I got the idea from the research analyst at JP Morgan who covers healthcare, who keeps a comp set for One Medical that includes disruptive healthcare businesses. And those names are, the companies in that group are Teladoc and Health Equity, Livongo, Phreesia, Health Catalyst, Progeny. And then I have two that I added to this list: Catasys, which is a personal addition of mine, addiction-related mental health, behavioral health company that has seen their stock price go from about 20 down to 10 during COVID, now up to over 30 recently. And then Acadia, which is a large public company that owns a lot of behavioral health facilities, psychiatric care facilities. Do all these companies compete with One Medical directly or with Teladoc directly or with AbleTo? No. But they're all disruptors in their respective healthcare markets. And so what do we see when we look at this peer group? We see a choppy market over the last few months for both the numerator. Okay, so when we're looking at valuation multiple, we're looking at enterprise value divided by revenue in this case. And so the numerator is driven by the stock price in the market and the cap table, the balance sheet, cash and debt, and the denominator, which is the revenue estimate. And so we're going to look at current trading multiples, and we're going to weigh them against how the multiples have been trending over the last year, 2 years, et cetera, however long we need to help us get a sense of what a fair valuation is. Some write-ups I've seen are focused on what we call NTM, or next 12 months revenue, which is the next 12 months of revenue for the business, which it's a public company metric. I highly doubt the person who leaked this to the press, to CNBC, took the time to annualize the numbers, calendarize them, and get quarterly NTM numbers for the sake of giving a quote to the press. So I'm betting this 10x forward number is likely based on 2020 expected revenue for AbleTo. So since we're in the first half of the year, it's really not a big deal. It's not a big difference, 2020 expected revenue versus NTM, but it makes a difference. As of April 30th, so what really matters here? As of April 30th, when the market closed, the trading valuations on a revenue basis for the comps I just mentioned to you were kind of all over the place. One Medical was at 10.3x revenue. Teladoc was at 14.7x revenue, which just yesterday, the day before, it was 17.5. And the first 2 days this week, it was 19.5, nearly 20. So there's a lot going on there. We'll talk about that in a minute. Health Equity, 6.5x revenue. Livongo, 11.5x revenue. Phreesia, 7.2. Progeny, Cadasys are right around 6x revenue, and Acadia is down at 1.8x revenue. They hover around the HCAs of the world and some of the other large healthcare providers at around 2-3x revenue. So more mature later stage companies that don't have the high growth prospects of some of these up and comers. If you toss out Acadia from that mix, for a whole host of reasons that I'm not going to go into here, but the average there is about 8.4x revenue. So based on this, the 10x paid for AbleTo seems slightly above market, or fair as one may call it. But what about Teladoc? Because Teladoc is trading at 14.7. It's been as high as 20. Why am I not getting that valuation if I'm a shareholder in AbleTo and if I'm a founder? And well, why aren't we getting that multiple is a question that every founder is always asking. And so I really wanted to kind of look into it. And what I found is that Teladoc's been around for a while. They're a mature, stable, $12 billion market cap company that shouldn't have a high growth multiple, like a SaaS multiple, right? Like a 15, 20x revenue. Teladoc's estimated revenue growth on an annual basis for 2020 is actually over 30%. They're expected to grow another 20% in 2021 and keep that 20% growth rate into 2022. That's incredible growth for a company, a $12 billion market cap company that's been around for a long time, a mature company, if you want to call it that. At the same time, they have best in market margin profiles, which is a result of their capital efficiency, meaning it doesn't cost them very much to grow. All of these factors win them a lot of favor with investors. So to my founder friends out there, take note here. Valuation at the early stage is often driven off how much money you're raising. But at the end of the day, as your business matures, valuation is driven by growth, margins, and capital efficiency mostly. As you articulate to investors what makes you special, keep those things in mind. It isn't just buzzwords about who led your last round and using the word AI or whatever buzzword of the day there is. You really, really want to base your valuation on growth, margins, and capital efficiency when you're telling your story to a sophisticated investor. So, digging further here, I wanted to see if some of the bigger multiples here are a fluke or not. So I looked at the historical chart showing Teladoc's enterprise value to next 12-month revenue going back to its IPO 10, 15 years ago. The average multiple over that time is actually 7.5x revenue, which is kind of close to the 8.4 average I just mentioned for the peer group. And if I look at the average over the last 6 months, I find 11.8x. This makes me think that the nearly 20x we saw a couple days this week was a fluke due to consensus estimates not updating as fast as the market digested future growth prospects for the business in this ever-changing climate world that we're in now. So maybe it's an estimate getting readjusted in the consensus numbers, or it's a stock price move one day, but the long-term trend for Teladoc shows more of a 10x, 11x, 12x revenue multiple business. And when you consider this, the average actually comes down to the 8.5 ballpark that we just mentioned for the broader peer group. One Medical, we were looking at them as a comp as well. One Medical IPO'd in January and has had an average valuation of nearly 10x to forward revenue the whole time they've been in the market since they IPO'd, even beyond the stabilization period. There's a lot of growth in that business. There's a lot of expected growth. They have venture backing. They had investment banker stabilization over the last 90 days or so. They have shareholder lockup periods expiring. So there's a lot of complicating factors around what's driving valuation, trading ranges, and volumes around One Medical. But look, it's a 10x comp, so it's something to look at. Another thing I want to cover here is private market expectations. So we've analyzed the public market data, and we've come to a sense of what fair looks like based on the set of comps that we've come up with. A little bit of art, a little bit of science there, right? There are countless private companies out there raising money, growing, getting acquired, and they're all comps as well, but we don't have visibility into their data. So the one thing we do have is we have relationships with investors who traffic in our industry and know what they think their companies are worth and what they think their companies will exit for. A lot of those conversations I hear ranging from 10x to 20x when we talk about exits in the behavioral space, with 15x being kind of a commonly discussed midpoint. So if this is what all the cool kids are talking about, then why didn't AbleTo get that value? Either the cool kids are wrong, the other VCs and the founders in the space, they're talking about how they deserve 15 to 20x, or we need to manage expectations, or there's something up with AbleTo. There's some missing information here, though. There's a lot of stuff we don't know about AbleTo. Which explanation is true? Is the company really worth 8.5 and they got a premium to 10, or was it really worth 15 to 20 and the company was sold at a discount? We don't know, but there's data points that we need to be able to really get to the bottom of this. We need to know what the last 12-month revenue was for AbleTo, or more specifically, their 2019 fiscal year revenue. We don't know their growth rate, how it compares to the comps. We don't know what valuation the investors paid for the last round. Well, we don't know it publicly. And, we don't know if somebody else is going to bid or has bid, or if there's any competitive tension in this process, the sale process, or if there even is a sale process. And if that's not enough of being in the dark, we don't know for sure how capital efficient they are and what will it take to win the next 10, 20, 100 million of revenue as they scale. All these things matter. If we had access to these answers, we could tell you pretty confidently whether or not 10x is a fair multiple. In my final analysis of the deal, all of this is telling me that the 10x number is pretty fair. It's not really an outlier up or down, but it does tell me that the investors aren't too excited and they're not willing to pay a huge premium. At first glance, I thought, One Medical's at 12x and Teladoc's at 20, so this 10x is a joke. But as I was trying to figure out how Aetna was thinking about this, a United competitor who's also in the AbleTo cap table, I wondered, well, why isn't Aetna making an offer here? Why isn't Aetna competing for this? Maybe they think United's overpaying. I don't know. If United was buying this for a below market price, and you would expect Aetna to come in and bid it up or try to take it. I mean, surely they wouldn't let their competitor get this thing for free or for cheap, right? So this kind of leads me to believe that we're looking at a fair market price, but then again, I don't know. I would tend to think that with the shift to telehealth and the increased demand for mental health services lately, that the high growth opportunities that are ahead of AbleTo would have commanded something more like a 10 to 15x multiple, something with a control premium built into it. I would have loved to have seen a 15x multiple because, look, I want to see our companies in our portfolio talk about getting that value when they exit. So why does all this matter? At the end of the day, we aren't here to try to say whether or not Optum and AbleTo are entering into a good or bad deal. We're here to figure out what the deal means for entrepreneurs, for founders, CEOs, investors, and other constituents of the mental health startup ecosystem. So we'll start with founders. What does this mean for you? If you're a founder, it does not mean that your next round is going to be 10x your projected 12-month revenue. Okay, don't kid yourself. Don't believe that you can pull out some swag of a revenue projection and put it on the page and get 10x that number in valuation for your next round. You're still going to be anchored in valuation by the basic governing physics, the laws of physics, these universal truths that guide early stage investing and valuation, which say you're going to be selling about 20% of your company in an early stage round. Maybe more, maybe less, but that's a good place to start. Not putting a 10x on your lofty valuation estimate. Also, later stage companies have a much easier time getting these multiples when they have a history of making projections and showing an ability to meet or beat those projections. You should be thinking about how you can start showing that track record from day one if you're thinking long-term about maximizing value. And what does this mean for investors? It's just one more data point. We have a handful of benchmarks to go off when thinking about what our company could be worth one day. And so this is just one more data point. We have One Medical at 12x revenue. We have AbleTo at 10x. We have Teledyne at 15, 14, 16x. We have investors talking 10 to 20x. So that gives you a sense of what a company could exit for 3, 5, 7 years after an investment. And that helps you back into whether or not you think you can hit a return hurdle that you need to hit based on the valuation you're going to pay today. So if I'm a founder and I know that, you've got to be able to do that math in your head. During an investor conversation, you need to stay one step ahead. If what I just said to you makes your head spin, or you think that's nonsense or you just don't, you want to deal with it later, you want to blow it off, then look, do yourself a favor. Dig into the details here, understand this math, because you're going to need to be able to do this in your head at all times when talking to a sophisticated investor. Bottom line, this deal is a data point. Okay, it's one data point. It's a very rich data point. It has a lot of value, or you can draw assumptions and triangulate to figure out the value of your own business in the future. But it's not a line in the sand, and it's not something that you can point to overcome weak growth or margins or team or bad product or declining market share. It's not something that you can use to sell through bad dynamics around your fundraise. But it is a data point, and I want founders to fully understand it so you can leverage it and get the most benefit out of it as you're raising money in our space. Okay, rant over, moving on. But back to AbleTo. Just kidding. It's not the only deal worth talking about in the market this week. As we conclude the first month of Q2 2020, I can't help but think about how mental health startup funding is tracking versus Q1 2020, which saw an explosive growth in fundraising numbers. And if you missed our analysis of the Q1 market and all the money that was raised in the space, you can find a link to that in the show notes. In Q1, we tracked over $460 million of funding into mental health startups. With COVID and the world seemingly grinding to a halt, we would think that maybe April would show a slowdown. Nope, not the case. In April 2020, mental health startups that we've tracked have raised nearly $175 million of funding, which is incredible. Now, look, $80 million of that came from one deal that just printed a week ago, and that's the Compass Pathways deal. So just a little info there. Compass Pathways raised $80 million as part of a Series B. One of their investors is Founders Fund. Another is ATAI, ATAI Life Sciences, which ATAI just raised $24 million the week before as well. If you want to know what's going on in the psychedelic space, I would track Compass Pathways, ATAI Life Sciences, Peter Thiel, and Founders Fund. They seem to be indicating where the smart money is going in that space. But April 2020 fundraising numbers are not inconsistent with Q1. You may say that, hey, look, $80 million, the one deal made up most of the market. Yeah, it did. But in Q1, we saw numerous deals above $50 million. Big checks coming into our space are a good thing. It means that later stage capital is coming in and validating the early stage thesis and validating the traction that early stage companies are getting in this space. And so big deals are a really good thing for our market. So as we see more traction and as late stage capital comes into the space, we should be encouraged. That means even more founders and even more early stage capital will be drawn to the space because the space is de-risking. So our market really hasn't missed a beat, is what I'm saying, since COVID. Now, so far is the caveat. Will May look terrible? I don't know, but we'll see. I want to wrap up with a few announcements. Coming up in May for Mental Health Month, we're going to be publishing content at a fever pitch pace, okay? We have recorded literally a dozen shows for the Stigma podcast for the month of May, and we're going to be doing this weekly mental health market update as well. So not just this month, but always. So please give us a subscribe, follow, a like, stay close. And finally, we want to hear from you. You can email us info@stigmapodcast.com. If you like our content, please subscribe on your podcast platform of choice. You can find us on social. On Twitter, we're StigmaCast. On Instagram, we're Stigma Podcast. And our website, stigmapodcast.com. So that's it for the first Mental Health Weekly Update. We hope to hear from you, and we will be back next week.